Good morning and welcome. Today we're going to talk about trailing stop losses. Okay, so today is learning session 11, June 3rd, and today we're going to talk about trailing stop loss. Now, trailing stop loss, first of all, let me just give you some brief thoughts. Okay, the best traders continue winning trades longer. Okay, so the best traders would continue winning trades longer. And one of the ways they do that is to trail stop losses rather than, hey, it's hit target one, it's good, I'm getting out. Okay, and they also make sure that they exit losing trades quickly. They don't keep holding on to a losing trade till or somehow it'll come back up. So they will try to exit it quickly also. This is what really good traders will do. Okay, really the smartest and the most wealthiest retail traders do this. They continue longer in the winning trade, and they will exit the losing trade fast. Okay, but all of this is dictated using trailing stop losses or stop. Okay. Now, you also need to learn how to book profits properly. And one way to help that is trailing stop losses. Because I've seen many times we will hit a target and then it might go a little back, go a little up, and then we're thinking, oh, it's going to go up again. But because we haven't moved our trailing stop loss, sometimes we'll just come back down and then we've lost all the unrealized profits. So you always need to aim for that first target T1, and then you check the momentum. The momentum is not that high. You can always exit at T1, but if the momentum is high, we should make sure we trail the stock rather than exit just simply at T1. Now, how do we ensure that we check for momentum? Always use a lower time frame. For example, I use the 15-minute time frame for my intraday entry and positions and all of that. But for momentum, I will use the 3-minute time frame, which is 20%, of the 15 minutes. So normally you use in a range of 4 to 6, a ratio of 4 to 6. So if you're trading on a 15-minute chart, for checking momentum, you'll use somewhere between 3 to 5 minutes, either a 3-minute one or a 5-minute one. I prefer 3 minutes. And if you are, so don't use a 1 minute for that. Sometimes I do, but normally I use 1 to 3 minutes. Okay. And for checking the trend, I use a higher time frame. So for momentum, always the lower time frame. And then start using a trailing stop loss. This is something that we got to get into our psyche. Now, the problem with the trailing stop loss many times is that it'll always get hit very fast. So you need to make sure your trailing stop loss is not something that can be easily hittable. At the same time, you've got to make sure that you are trailing it sufficiently so that you don't lose out on profit. Okay. Now, what is a trailing stop loss? Basically, it is a stop loss, but that it is not minimizing our losses. It is helping us not lose out on unrealized profit. So, for example, if I buy something at 400 and it goes to 410 and I put a trailing stop loss at say 405. Now, in case the stock comes down, at least I will get 5 rupees. See that? Rather than not end up with anything. Okay. And so that's what a trailing stop loss is. It's basically a stop loss that helps us not to lose out on unrealized profit. What is an unrealized profit? Basically, unrealized profit is profit, on paper or on the screen. Oh, I'm 2,000 rupees up. No, you're not 2,000 rupees up. Your unrealized profits is 2,000 rupees up. As long as you don't book that, you don't have the 2,000 rupees in your hand. And trust me, the 2,000 rupees can come and go the same in the next 5 minutes. Okay, you can see 2,000 rupees and then next 5 minutes, no 2,000 rupees. So it is never your actual profit until you book it. Okay, so it's always unrealized profits are only just virtual profits. And a trailing stop loss will make sure that you don't lose out on unrealized profits. Okay. Now, I mentioned that I started a little bit of futures, crude oil commodities. And so here's an example of what I did yesterday. Okay. So I'll just show you an example here. First of all, I actually went short on this trade here. And I watched it go all the way down here. But when this candle changed, I bought it back and I made a profit. I made about 1,800 rupees here. So when it changed here, I knew it was going to go up. So I bought in here. So I entered at 2704. And initially my stop loss was at 2692. But when it reached around, when it reached around 2,724, I put a stop. I increased my trading stop loss. I put it at, so that has increased by 20, right? So I increased this by 10. Okay. So my new stop loss was 2,000. No, I increased it by 22. So my new stop loss was 2,712. So it's somewhere here in this region. And then I went off, when I came back, the market had gone down to 2,700 on this candle, and it hit my stop loss. So what happened? So I entered at 2,704. When I came back, the market was around 2,700. 3 or 4 or 2 or something around that mark. So basically, instead of getting this profit, I would have lost out and made a loss, right? But because I had a trailing stop loss, I ensured I had about 800 rupees gain rather than 200, 300 rupees loss. Okay, I could have exited it here, but again, I was just watching the market mature. If I had actually tracked it going down, I would have sold it out earlier, but I wasn't tracking it. So then a trailing stop loss helps. Okay, now where do I place a trailing stop loss? Some practical steps here. If we cross T1, we can always put, and there's good momentum, it's going up. You can always put the stop loss at trailing stop loss at T1 now. So even if it comes down, at least you get T1. Okay, if you get 1%, right? It's important. So 1%. Second one, I would use the MACD crossover to probably indicate that's where I need to exit, and a trailing stop loss can be kept there. I also can use the moving average on the lower time frame as my stop loss. I'll show you that. Okay. And then of course there's the percentage rule. I bought it at one price and then it's gone up 2%. I'll put it at 1% trailing stop loss. It goes up 3%. I'll put the trailing stop loss at 2%. And like that, I can keep increasing my trailing stop loss. Okay. So let's look at an example. We did Mindtree yesterday. Okay, I did Mindtree yesterday. I got in at 920.7. Now I'm using the 15-minute chart, right? I got in at 920.7, and so I put my trailing stop. I put my initial stop loss at 912, and that was my initial stop loss. And then what I did is when the stock started moving up, I immediately shifted to a lower time frame, and the lower time frame I used was the 3-minute chart. So when you see in the 3-minute chart, you can see that, yeah, here I entered, here's my stop loss, and it's going up like this, like this, like this. So I need to know when to get out. I exited at 9:38, just so you know. I exited at 9:38. Why I exited at 9:38, I'll tell you later. But what did I do with my stop losses? There's two options here. Okay, now there is momentum and it's going up. There's two options here. What can I do? One is I can either put my trailing stop loss at T1. So I got in at 920-ish. My stop loss is 912. So my first target is around 930. Once it crossed 930, I can always put my stop loss, and it's still going up, right? So around 938, I can say, hey, I want to put my trailing. It actually went to 942. So I'm going to put my trailing stop loss at 930, which is T1. So even if it comes down, I can exit. So initially my trailing stop loss was at 930. I then brought it up to 935 later. Okay, because this is a 3-minute chart, the EMA on the 3-minute chart moves faster than the EMA on the 15-minute chart. For example, the 15-minute chart EMA is at that point is at 910-ish. Okay, 910-ish. On the lower time frame, the EMA is at that time is about 924. You can see here, 24-ish. So what do? I can either do a trailing stop loss at target 1, which is easier for you guys to figure out, or you can do a stop loss along the EMA line of the lower time frame. So why I got out at 938 is simply because the MACD line cut here, and that was a sign for me that I should get out. Okay, now this MACD is again on the lower time frame, like the moving average. The MACD is also the lower time frame, but I felt because also another reason, you see these candles, it's indecision or a evening star pattern, basically that this is a trend reversal here. So it went to 942 and it's coming down, and so I got out at 938. So this was about 45 minutes in. Okay, 45 minutes in, and I got out. Okay, you can see here again. There's a hammer down, or sorry, a shooting star here, which in the 15-minute time frame you can see that is actually a shooting star, but here on this it is a evening star. But anyway, that was a trend reversal signal by candles, so I got out. But two ways you can do this. Either you can do it with the trailing stop loss at your target, or with the trailing stop loss based on the EMA line. Okay, I used sometimes kind of both, and sometimes it works against me also. I keep it too close and it gets hit. So it's happened to me. I know it's happened to some of you also, but that's okay. So these are the basic thoughts that I had, and so that's the reason why, because the MACD. Now, if I had kept it, okay. Now another thing, if I had kept it on the trailing stop loss, I could have got out at on the EMA line. I could have got out about 931. 931, 932. If I had kept it on the initial 930 T1, I would have got out 930. But instead, because I saw this, I got out at 938. So there's a lot of reasons why we exit, but at least the stop loss principle you got to understand. Okay, we want to save as much as money as we can on the stop loss.